Hello ladies and gentlemen, welcome to our first weekly video commentary, the Australian Gold Weekly Wrap-Up, proudly presented by the Australian Gold Fund, a trusted name in the Australian precious metals and mining equity market space. I'm your host Ved Shah, and joining me today is our founding director and managing partner at Gold Hub Australia, our Precious Metals Information Forum, Brian Chu. How are you doing, Mr. Brian?
I'm good, thanks, Ved. Glad to be here, and I'm very excited about this program.
Right. All right. So what can you expect from Mr. Brian and I in these videos? We'll cover the latest developments in the global economy concerning gold, silver, and precious metals. You'll also get a brief update on Australian gold and precious metals and mining companies. Brian will share his commentary and opinions to help you identify what's important in this space. That's what sets us apart. You're going to get an exclusive sort of insight and forecast into what lies ahead in the precious metals and mining space. Please note that none of the content in this video qualifies as financial advice. They're for educational and entertainment purposes only. And I think you're waiting for the show to get started. So without any further ado, let's move ahead. So let's get into gold. Moving first, we've seen that the prices of gold have sort of approached the US dollar 3,400 mark again this week, when it was almost down from US dollar 3,300 last week. And that is primarily because of three different factors. The first factor is that the US non-farm payrolls report came out on August the 1st, and we've seen only 73,000 jobs being created in July. And what's worse is the fact that the jobs data for May and June have been updated, and they've been decreased by 258,000 jobs. Now, as a result of that, President Trump had chose to immediately fire the chief of the Bureau of Labor Statistics on August 1st. And the Fed governor had chosen to resign on the same day, and President Trump has suggested some short-term replacement for her. So that is the first factor. People are now speculating as a result of these US non-farm payrolls report that the Fed is going to cut rates starting in September and October, and the Australian Gold Fund has projected this probability to be around about 60% in September and October. And that's 60% for, I believe it is 4% to 4.25%, and around about 30%, I believe, for 4.25 to 4.5%. So that's the first factor. Moving on to the next factor, we've seen a lot of regions where the tariffs proposed by President Donald Trump have now come into action, which means that they've been executed, including a 50% tariff on goods imported from India, after President Trump's claim that India has continued to purchase their oil from Russia, despite the ongoing war between Russia and Ukraine. And the last factor is the falling of the US dollar yet again this week as a result of these two factors that we've mentioned above. People's confidence in the US dollar has decreased as a result of all these macroeconomic events, and as a result, the US dollar index has this week dropped yet again from the 100-point range to the 98-point range, causing gold to soar almost close to $3,400 this week. And silver sort of emulated gold's position, gold's rally as well this week. We've seen silver go back to the $38 range as it was previously. It's yet to go to its all-time high position of $39.40, I believe. But yes, it has climbed back up to the $38 range and has emulated gold's position this week. So what are your thoughts on the same?
It's interesting, Ved. Thank you for the outline. I'm going to first start off with the US jobs data and also the reaction from President Trump towards the Bureau of Labor Statistics. Now, it's never a good look for a leader of a country to go and sack the person who's in charge of the organization providing the data. Now, I have written in the Factor Investment Research newsletters about how I personally don't really trust the official statistics that come out of most government bureaus and agencies. It's not just a US thing. I have doubts about it in Australia. And I know some people used to love laughing about China and saying, oh, most of the statistics coming out of China is fake. Well, everyone knows that bit, but very few people seem to appreciate the fact that it's almost the same everywhere else. And the US is pretty clear at the moment that while some people go, well, President Trump is nuts, he's a dictator for sacking the Commissioner of Bureau of Labor Statistics, Dr. Erica, and I forgot the surname. I always keep forgetting it. So he sacked her and accused her of being political. Now, she's not the only one, really. Getting rid of the head is not going to stop the whole body of the snake. Most people who have followed economic data would realize that the jobs data, the inflation data, rarely reflects what Main Street people, ordinary people experience. And the sacking brings to light this type of problem, and hopefully people see past the knee-jerk reaction from President Trump and go and start looking at why did this happen. And people will eventually come to realization that the data we keep hearing about in the news, and this is a data that moves the markets, and the central banks also, the Federal Reserve relies upon this data to inform their monetary policy. We just saw that the Federal Reserve had said they would keep interest rates on hold in July, and that pushed gold down and pushed the US dollar up. As soon as the jobs data came out, everything got reversed. What that's telling us is that the market has further doubt about the credibility of firstly the data or their trust in the Federal Reserve and central banks for that matter. So even if there is a potential threat of recession coming in the US, the market is now pricing in the belief that perhaps there will be a higher chance of a rate cut in September, and maybe the Federal Reserve was wrong to have just kept interest rates on hold in July, because as soon as the jobs data came out, it just basically basically blew the whole thing out of the water. Now, with the performance of gold in the recent few days, we've seen it go back to the type of the levels we saw back in much of May and June, before the Israel and the Iranian conflict subsided. And so what we're seeing is the fears over the tariffs impact on the economy is probably is still there, even as the US is reporting that the tariff revenue is actually looking quite good. The market's still doubting how long this would last. So on one hand, they're very bullish, and that's why the stock markets are up, but they're also looking carefully at the impacts of this on inflation, and that's why the US dollar is down and gold is up. It's almost what we call a bipolar market. People are overtly bullish and buying stocks, but people are also overtly cautious about economic situation. So that's why gold and silver are also doing quite well.
Right. So maybe a way to look at this is people are looking at this from two perspectives, as you said. So the impact of the tariffs is definitely going to have an impact on supply and demand in the US. And that as a result is going to be affecting a lot of revenues and costs for local US companies as well as companies abroad. So people are sort of taking in this supply, demand and revenue cost factor into consideration. And given that these tariffs is going to boost sort of US production and sort of US supply within the country, people are sort of bullish on the equities. But at the same time, as a result of exercising these tariffs, we see that the country is going into trouble because of inflation concerns. And now the Fed's going to have to cut rates. to sort of stimulate borrowing and to sort of stimulate spending in the economy, which is going to lower the treasury yields. And as a result, people are rushing into gold. So despite the fact that these tariffs are good for companies based within the US, which is pretty much every company in the S&P 500 as well as the Nasdaq, I believe, people are putting their money into equities, but they're also taking into account the macroeconomic consequences that this can have on the country as well as the world, and hence they're putting their money into gold as well. Is that how you would look at the situation?
I think that's actually a very good way to summarize what we're seeing. I think the biggest casualty at the moment, on one hand, is of course all the countries that have not satisfied the Trump administration's demands on trade conditions, and the other is the US dollar, because the US dollar is unable to break above the US dollar index of 100, the 100 mark, which it last touched back in, I think it was May, and only then it was only a small bounce. The US dollar index again seems to be back in a bearish trend, which is also part of what the Trump administration wants, because they want to increase the competitiveness of US exports.
Right. And now I believe that will bring us to the next chapter in this weekly commentary. Let's talk about Australian precious metals and mining stocks. So to start off with sort of a broad view, if you have a look at the ASX statistics on their website, you'll see that the materials sector has gained the highest amount out of all the sectors on the ASX 200 this week. The materials sector as a whole has gained almost 4% this week, and that has sort of bled into the ASX All Ordinaries Gold Index, which has risen by 700 points in the past few days. It was around about 11,000 points, exactly 11,000 points on August the 4th. And today, as we talk on the August of 8th, it's at 11,700 points. Now note that we've been writing market commentaries for Gold Hub Australia for quite a long time now. It's been almost a couple of months since we began this exercise. And I can say that this is the largest rise that we've seen in the last 2 months in the ASX All Ordinaries Gold Index. And as far as we're concerned, this is the largest magnitude that we've seen as well, rise or fall. We've also written commentaries where the ASX index has fallen by 600 points, but 700 points this is a magnitude that we're seeing for the first time ever since we started writing these market commentaries. Now, there's a reason why we believe this is happening. The first reason is that gold's rally has taken off yet again, and that is exactly because of the reasons that we've discussed so far in this video, that there are broad macroeconomic consequences with regard to the interest rates that are going to be cut starting September and October, or at least people are convinced that it's going to happen. What that's going to do is that's going to decrease borrowing costs for our precious metals and mining companies, and that's going to sort of ease down, sort of create an easing effect on the company's balance sheets for the upcoming financial year. Now, this is a special consideration as well, because not only the Fed, but the RBA, the Reserve Bank of Australia, has also almost hinted at cutting interest rates, I believe next month and the month to come after that as well. So that's going to sort of ease the balance sheet for many of our precious metals and mining companies based in Australia. And at the same time, the macroeconomic consequences of this is also going to help them increase the gold sale price for the upcoming financial year. And that, I believe, is the reason why the ASX All Ordinaries Gold Index has risen by 700 points. Because not only do these companies now have an opportunity to increase their revenues, but their cost of borrowing has decreased as well. So that's sort of the perfect scenario for the precious metals and mining companies. And I believe that is the reason why not only the gold index has risen by 700 points this week, but also the materials sector has gained around about 4% this week, being the strongest sector out of the, I believe, multiple sectors in the ASX index.
Yeah, so there's a few things to unpack here. The first one is that there is a significant there's a bull market that's happening in the commodities side of things, especially because the US tariffs on one hand is pushing trade back toward in favor of the US compared to the other countries. But at the same time, the commodity prices have also increased because of concerns about disruptions to supply chain, as well as also the artificial barriers that are being placed against companies exporting to the US. With gold, we've seen that it's a combination of the weakening US dollar, expectations of inflation, and a recognition that the fiat currency system is increasingly unstable. In Australia, the fears about the global economy has caused the Australian dollar to weaken, and that's why the Australian dollar relative to US dollar, it's been trading in between about 63 to 66 cents US cents in the past few months. Now, in the past, the Australian dollar averages about 70 to 75 US cents. And the last 5 years, of course, we have a very unusual time. And that's why the US dollar has been more a safe haven currency, at least compared to all the other global currencies. Of course, except gold, which has actually gone up by, it's doubled in 5 years and tripled in 10. So in Australia, the mining companies, the gold mining companies especially, they have enjoyed the rally in gold, but then up until probably about 2022, late 2022, there was a period when you had the Russia-Ukraine conflict that caused oil to spike. And that really killed the profitability of gold mining companies on top of also the border restrictions. We've seen that behind us. The interest rate rises are over. Interest rate cuts that began last September caused gold to rise significantly. Oil also came down at the same time because of increasing supply by the Middle Eastern countries, the OPEC nations, and also the US further added to this by increasing oil supply into the market that led to oil trading in the mid to low $60 a barrel. Gold mining companies have seen a gold to oil ratio rise to as high as 55. So 1 ounce of gold buys 55 barrels of oil. We haven't seen that for a long time, and it's been trading at 45 to 55 level. That allowed gold mining companies to generate record revenues. We saw that in the June quarter. The operating margins, which is the how much they sell their gold for relative to how much they mine it out of the ground based on all-in sustaining costs, that rose to 52% for the average was 52% based on the company's realized gold price. But if I standardize it across the quarterly spot price, because some gold producers hedge their gold and therefore they sell it at a lower price than they would in the spot market, even that, the operating margin is about 48%. This exceeds the highest level that we've seen back in 2020 by about 5 to 6%. Very significant. That's why you have seen gold mining company, gold producers report record cash builds. They are operating on very generous margins. And now that's with the expectation that the interest rate's going to fall further and gold could rise even higher from there. The market is back in there to snap up these gold producers. Now, having said that, I have been on record on AusBiz. We've also written about it in our newsletters, our weekly commentary, and I've also written this to my Fat Tail investment newsletter, paid newsletter readers. I think that there are signs that a lot of these producers are slightly overvalued. And so rather than chasing this rally and jumping in head first, I have urged caution. I'm not saying that it's time to clear your portfolio, or I'm not clearing my portfolio in this case, but there are places where I'm taking profit and then looking for better value elsewhere. So that's why at the moment it's worth being cautious, as the ordinary investors are going to get really, really excited about what's happening in gold, and they might chase this bull market and turn it into a bubble.
Right. That's an interesting way to look at things. And I believe we have one of our own valuation models at Gold Hub Australia that sort of juxtaposes with what we've just spoken about, and that is our gold producer fair valuation model. I think it's called the ASX Gold Index valuation model, and
the Gold Stocks Valuation Index.
Yeah, the Gold Stocks Valuation Index. Yes, my bad. And that is our unique way of identifying whether gold producers, only producers I believe, not explorers, whether gold producers are fairly valued, overvalued, or undervalued. And given that we've just spoken about the fact that companies are seeing record operating margins, that's allowing them to produce record free cash flows and record cash flows at the same time, and they're sort of strengthening their balance sheets heftily. What we have seen is that gold producers, according to our valuation model, are now trading within the fair range. And this you can see in the company's stock price movements across the past month. So if you have a look at Northern Star Resources, if you have a look at other companies of the same size as well, you'll see that their year-to-date price, the price within the last 5 days and the price within the last day are all in the greens and sometimes in double digits. But if you have a look at their price compared to last month, exactly last month, you'll see that they're in the reds, not the greens. So is it fair to say that despite the fact that the market may be excited about these record operating margins and free cash flows, especially given that now things are better, given that the RBA is going to cut rates, that's going to sort of make borrowing easier for these companies, that's going to ease on their balance sheet, and they're also going to see an increase in gold sale price if gold's rally continues this way. Do you believe that these producers are yet again going to be in the overvalued range? Or do you think that given the fact that now they're fairly valued, they're back to the fair valuation range, do you think this is a good time to put the money into these producers again?
Good question there. The Gold Stocks Valuation Index, for all of you, will show you the figure later on. Check out our newsletter that comes with this video. The Gold Stocks Valuation Index is at about 65% or so, and it's a scale between 0 to 100%. I normally deem anything between 75% to 100% to be overvalued, between 0 to 25% as being undervalued, and the fair valuation range is 40 to 60%. So we are currently at somewhere around the upper end of the fair valuation range. We're creeping up towards overvalue range once again. Now, between March to mid-June, this index went up to as high as about 82%, and it only started coming back down to about 52-53% late last week, just before the turnaround for gold. Now, is it possible that gold stocks could return to that overvaluation range? It is possible. If gold goes up, but gold stocks go up further, so let's say gold rises another 5%, but gold stocks rise by another 10-15%, which is entirely possible because at this level, at the current level of about 11,700 points, another 15% rise would take it to about 13,400, which just breaks the record that we saw on the 13th of June. That could happen. If the interest rates retreat, if there's further interest rate cuts, that could send the market to become particularly enthusiastic once again, and that could lead to the market for gold stocks actually being overvalued relative to gold. The other factor is of course oil. If oil rises along with gold, then it offsets the profitability for these gold mining companies because oil is an important input factor. So in short, I would say track how much gold stocks rise relative to gold, and we'll definitely make our decisions accordingly.
All right, I think that answers the question. And moving on to the last part of our discussion for the day. This is not a part of our weekly commentary, but I believe this is a question that most of our viewers will have given the points that we've discussed today. And please be aware that none of the discussions happening on this video are any form of financial advice whatsoever. They're only meant for educational and entertainment purposes, and we recommend that you do your own research before making any investment decision. That is unless you subscribe to Fact Investment Research. Given that we may see these gold producers entering the overvaluation range once again because investors may get excited about the RBA cutting rates as well as the gold sale prices increasing in light of gold's rally. How do you distinguish between market sentiment and company fundamentals? So let's say that, for example, Westgold Resources has increased by 5% within the last day. Let's say that Westgold Resources' rally continues as an example, and investors may see a crazy amount of value in the company. But how do they distinguish between pure sentiment and company fundamentals?
Okay, if you're looking at producers, we have something called the valuation to profit margin multiple, and we compare the company's current valuation against their current production, the cost of production, the all-in sustaining cost, how much they sell their gold for, and the amount of ounces they have in the ground. So we've built that ratio, that multiple over the last 10 years. And that informs our evaluation of these companies, these producers, on whether they are profitable, they're attractive, and whether there's further potential for them to rise in this market. For developers and explorers, it's a little bit harder because they're not producing, they're not earning any revenue. Then you have to evaluate them by their projects, by the stage in development, and also their financial position, and all that. So there's a little bit more of what I would call heuristics and subjective judgment for those. From there, we have to look at it from a project-to-project perspective, and those smaller or early stage companies are driven much more by sentiment because that drives the fund flows and the trading volumes. The fundamental value, I would look at that based on the companies, like their projects, and finding something comparable. You would get to know more about these valuation if you sign up to the newsletters at Factor Investment Research. We also provide recommendations in that service. In Gold Hub Australia, we provide the raw data, and we provide you with a little bit of our insights into how we interpret the data, but the investment decisions is completely up to you, and we do not provide any financial advice from that respect.
All right, so that wraps up today's episode of the Australian Gold Weekly Wrap-Up. We hope you enjoyed it, and please leave your comments and questions below if you have any. Who knows? This is something that we might cover in the next episode if we find the question to be interesting to cover. We want that you treat this series as a joint project between us and you. So this is not a one-way discussion where we sort of bring our own insights and our own commentary, but we also want you to ask meaningful questions and have comments, if any, and we will include them in our series without a doubt. If you'd like to find more about what we do at Gold Hub Australia, please visit our website. The links are in the description below. And finally, we do not receive any form of endorsements or sponsorships from anyone. We thrive on your continual support in the form of viewership. So please pass on this video to someone who you know are interested in finding out about what's going on in the gold and mining equities in Australia. So thank you for tuning in. And from Brian and I, have a lovely weekend and we'll see you next week.
Thank you, ladies and gentlemen, and God bless.